All right. Well, I think we're live here. So good afternoon, everybody. I'm Caleb with YCharts and really excited about today's webinar. For everybody that registered, we've got a surprise for you, right? So the title of this webinar, when you got your invite and probably signed up to join, was 5 charts to show your clients midway through 2021. We did sit down with that goal to come up with 5 really compelling charts. And what we did is we came up with 15 working with our friend Charlie Bilello. So we really, we decided, midway through the year, this was no time to get stingy with charts. No reason to narrow it down to only 5. And so we've got 15 to bring you today. But without further ado, go ahead and make a quick introduction. So, anybody that doesn't already know Charlie or follow Charlie on Twitter or read his blog, you certainly should. Charlie's always got great insights. Charlie actually joined me, what was it, Charlie, a few months ago, maybe early in the year when we talked about some trends that you were identifying for 2021. So excited to rehash some of those, but couldn't be more excited to have you back on today. If you haven't read the entire blog that Charlie put together, visit his website at Compound Capital Advisor. Go to the blog. We've got 15 charts today. I think there might be closer to 40 or plus on the blog that you put together for the mid-year. So certainly check that out. Charlie, too, I know we were talking a little bit yesterday as we were getting ready for this, and you mentioned that you get the question a lot from advisors, that want to reuse your charts and kind of use those to talk about certain trends that you've pointed out with their clients. What's your stance on that?
Yeah, absolutely. Feel free. And a lot of the charts are open-ended, so you can interpret it any way you want. So, put it into your monthly or quarterly recaps or just your conversations with clients. So yeah, we encourage everyone to use the visuals as they like.
All right, great. So there you have it. You've got free reign to use the charts. We are also going to make it extra easy for any YChart subscribers to get these charts within the platform. They're all going to be loaded up as templates. So if you go into our fundamental charting tool, just look for the midway through 2021 section there, and these 15 charts or close to these 15 charts will be there for your use too. The last housekeeping item before we jump in and start getting into the content, if you do have any questions, please use the Zoom Q&A feature. You should be able to see that. You can type your questions in there. Any questions that are a little bit more tactical in nature, we do have some people standing by to answer those on the spot, but Charlie and I are going to field a lot of those questions at the end. So ask them as they come to you, and we'll do our best to address those at the end before we wrap up. But with that said, let's jump right into the first chart. And Charlie, I'm going to pull these charts up and let you give a little bit of voiceover of what we're looking at here. I think I've mentioned when we've worked together in the past that your charts do such a good job of telling a story, but, love the voiceover that you can provide and kind of walk us through, each part of the story here.
Yeah. So this kind of sets the stage for the whole year. Coming into the year, it seems like an eternity ago, but coming to the year, there's a lot of fear and worried, and rightfully so, around COVID. The vaccines were just starting to roll out. We thought they were going to be pretty effective, but at the same time that we were distributing them, the prevalence of COVID in the US was hitting its peak. And so we had hospitalizations. This is a chart of hospitalizations in the US hitting its peak in early January. If you look at a chart of cases or a chart of deaths, you find a similar peak in January there. So, the fear was, well, how long is this going to take to come down with the vaccines? And is that going to lead to people starting to travel again? Is it going to lead to the economy reopening? All of the things that we're hoping for. And then, of course, we see this sharp move down from that peak in January that really continued through the end of June. So a 90% reduction here in hospitalizations, and that really drove deaths lower. We have now over 50% of the population vaccinated, through 6 months, and really that's reduced the numbers dramatically, and it's filtered in. It's kind of set the stage, the background for everything else that we're going to show today.
Yeah, I mean, pretty cool chart to see. I know we started tracking all of the COVID statistics on YCharts back in, I think, March of last year. And
yeah,
really seeing the wrong trends in the charts, right, as things were going up. So being able to look back and see this, it feels good to have some positive data here. But I guess moving into the next chart, one of the biggest things that we saw a huge decline in early on were jobs and job openings. But talk us through what's happened since in this chart.
Yeah, I mean, if you went back to February, March 2020, and you said that there was going to be a record amount of job openings a year later, I think people would have probably said you're crazy. But here we are. This is a great sign for the economy. To be clear, jobs are still in the process of recovering, but the openings are there. So this is just a chart of job openings over time, and data goes back to 99, 2000, and we've never had more job openings in the U.S. than we do today. So I think the last employment number we had, there was around 10 million unemployed. So, as the summer progresses here, as the extra unemployment benefits start to roll off, I think you're going to see bigger job numbers in the fall, and hopefully we start seeing employers getting more job applicants and filling these jobs, and really ramping up the recovery, which is still missing for some parts of the economy.
Charlie, so it sounds like you're looking at this, all these job openings as a huge positive, right? I guess I could kind of flip the table a little bit and say, hey, is there a lack of demand for people to actually fill these jobs, and is that creating problems in certain sectors that we could be aware of? But it sounds like, your take is that based on some of these benefits are going to be rolling off soon, you expect to see these filled?
Yeah, absolutely. I think half the states, now, the past week or two, have discontinued those extra benefits. So I think we're going to see that, in early August in the employment numbers for July, the effect of that. And we'll see that into September. I think that's when it expires unless they extend it. So for sure, I think there's certainly businesses that are hurting. Anyone who's been to restaurant lately, you could just talk to the owners, and they're having problems hiring people, right? That's clear. And the fact that there are openings, I think, is, you have to look at that as a positive, because when the people are ready to work and when they're coming back, the job is there available for them. So I think that's a great thing, and this is going to be huge throughout the last 6 months of the year. Hopefully, again, we fill all those jobs and get back to that pre-pandemic employment number that we had.
Yeah, certainly. And I guess, proud to be a contributor to this data. YCharts is also hiring. So if you have any, if you're listening, you've got anybody in your network that think would be a great fit at YCharts, let us know. Shameless plug there. But moving on, away from, I guess, the reopening and the jobs, onto, some of the effects of real money, or free money, I guess, rather. Charlie, can you talk us through this one?
Yeah. So this tells really an unbelievable story. The fact that retail sales are where they are. Again, nobody really anticipated that, but I suppose nobody anticipated the amount of stimulus that we would have over the past year and a half. So the bump up on the right side of the chart that we've seen in 2021 comes from those two additional stimulus rounds. So the biggest one yet we had in March, and consumers, while they saved a decent portion of that stimulus payment, they're spending it now. So the backdrop of COVID becoming less of a risk, people are traveling again, people are spending money on their homes, people are spending money in a lot of different places. And so we actually have retail sales today 18% above their pre-COVID levels, which is pretty unbelievable. And that's driving a lot of the other impacts on the economy. And it's driving that job opening number for sure. So you have this increase in demand. You don't have the labor force that you want, and so you have this huge job openings, and really employees have the upper hand for the first time in a long time because of that. There's just a lot of demand and not enough supply, and that's going to filter into the next few charts we see.
Yeah, I guess before we move on, Charlie, do you think that this kind of spike in growth in consumer spending can sustain?
No. So no, it's definitely a consequence of literally handing out money to people and not taxing it, saying you don't have to pay it back, and people, irrespective of whether people lost their jobs, right? So we didn't tie the stimulus to being unemployed. So a lot of people didn't lose their jobs. They may even got raises in the last year. If they were in the tech sector, they probably did pretty well because of what happened last year. But they still got that stimulus payment regardless, and they're spending it. So So no, that won't continue. It'll probably stay above average levels for a few more months, I would think, because of the savings that we've seen. Like I said, they're not spending all of it, so we haven't seen the full effect of it just yet. But no, it's certainly not sustainable without another round of stimulus, which I haven't heard yet. So, but who knows? I suppose anything's possible.
All right. Well, let's flip to the other side. Looking at manufacturing instead of consumerism. So
Yeah.
this ISM PMI number. Talk me through this. This one's always been interesting for me, but something that I've never really completely wrapped my head around. So what is the signal here?
Yeah. So this is just a survey of manufacturers. They do each month, and the reading is kind of scaled where it's above 50. That means manufacturing is in expansion. Below 50, it's in contraction. You could see the sharp dip in 2020 there, and just the complete V-shaped reversal. And coming into this year, we see it hit its highest level since the early 1980s. So you have this huge increase in demand. So retail sales are going up. People are buying more goods. They're putting in car orders, a million different things. Semiconductors, we could talk about. Pretty much every industry seeing a bump up in demand, and manufacturers are just trying to ramp up output as fast as they can. So if we looked at, there's many components to this index. If we looked at new orders, you'd see something similar. So just a huge increase in manufacturing activity. And again, if you ask again, is this sustainable? Is it going to continue? Again, unlikely. It may stay above 50 for a while, probably will, but that extreme level of activity is unlikely to maintain for very long. But it just shows you how much manufacturers needed to ramp up given that sharp increase in demand.
Yeah, and hopefully a healthier supply chain after some of the issues we experienced over the last year. But with this PMI number, is this something that you view as a leading indicator as opposed to one that lags?
It's certainly a leading indicator for the economy by a few months for sure. But in terms of the stock market, probably more coincident at best. So I wouldn't use this as an indicator to say this is doing really well, therefore stock should do well going forward. Tend to actually see the opposite historically, where very low readings, depressed readings, tend to have better returns going forward because it's more likely you're going to be in a recession at that point, and stocks are cheaper. So it's not so much a stock market indicator, but it's definitely, it has been historically a leading economic indicator. You could see going into 2020, it was starting to already show signs of weakness before even COVID hit. So, we'll see what happens here. We're just in the middle of a cycle. This could continue to stay above 50 for years, or it could come back down. It's a pretty volatile index historically.
Sure. So bullish for GDP will yet to be determined on the stock market.
Yeah, for sure.
All right. Next chart gets into inflation. Obviously a hot topic. So I guess just kick it off, and I'm sure we'll have a lot to talk about here.
Yeah. So we got two lines here. The light blue is the overall CPI in the U.S. So just taking a basket of goods and looking at the year-over-year change in that basket. And so overall, we're up around 5.4%. That's the highest since 2008. But if you strip out food and energy, which is known as the core CPI, looking at around 4.5%, that's the highest since the early 1990s. So for sure, we're seeing the effect of that too much money chasing too few goods phenomenon. So huge spike in retail sales, consumer spending, and just limited supply. Manufacturers are trying to keep up with that demand. They haven't been able to. So if you dig within the CPI, you'll find things like used cars up 50% over the last year, and it's something that you've probably seen, or people on this video may have experienced or heard stories about. But it's an unbelievable thing. What we're seeing in the used car market, where there's only a few $100 gap between one-year-old vehicles and new vehicles. It's especially true in the truck market, where there just seems to be very limited supply and a lot of demand. What you're seeing there is actually some sales of used cars actually at profits, which is really unheard of. Usually, there's the old saying that when you step off, as soon as you drive off away from the dealership, your car depreciates in value by some percentage. And the last year really really questioned that phenomenon, at least short term. But that's not likely to persist. The question is, are these other areas, are they going to stick, or what areas are we going to see a above average level of inflation going forward? So, before the pandemic, we were averaging around 2% inflation, really over the prior 10 years. And even if we look back 20 years, it's, since 2000, we've been averaging around that. And are we going into a period where we're going to see 3% inflation or higher going forward? And that's the big question for market participants.
Yeah, so I mean, some of those things you talked about, scarcity definitely played a part, right, in some of those extreme situations. But
yeah,
think about inflation, and when you think about portfolio management, what are some of the ways that you look to hedge against this inflation problem, in a portfolio? Is it just being invested in the markets? Is it you look at tips? What are some strategies that you would recommend?
if you look historically, you'll find that stocks are pretty decent inflation hedge. Usually companies are able to pass on that inflation to consumers. And if we take the extreme example and look at hyperinflationary countries, if you look at something like Argentina, Venezuela, and you look at their stock markets, they actually do pretty well. So caution people to think that super high inflation is going to lead to a crash in the stock market. You might have less purchasing power when you sell those stocks, but that's a different animal altogether. So stocks have historically, over a long period of time, have been the best "quote unquote" hedge against inflation because they've outpaced inflation. They're not just hedging it; they're not just keeping up with it; they've outpaced it. And after that, if you look at things like REITs or commercial real estate, they've done phenomenally well. I think people like to talk about gold as being a good hedge against inflation. It has been at times. There's been other periods where it hasn't been. Gold historically has roughly kept up with the rate of inflation, so it hasn't outpaced it. And then there'll be commodities in general. There'll be times where commodities do very well, keeping up with inflation. Certainly last year we've seen that. There'll be other periods where not so much. So stocks in general have been the best, broad major asset class to keep up with it. If you look at things like tips, they'll do better than your typical nominal bonds, but in terms of keeping up with inflation, but not comparable to stocks or other areas.
Yeah, Charlie, I think one of the charts that I saw on your blog post, I'm not sure if we made it into our top 15 here, was just the performance of the ag year to date. So
yeah,
obviously stocks doing well, or tending to keep pace with inflation. How are you talking to your clients about their bond investments and the decline there?
Yeah, bonds have had a very interesting year. The last time we were speaking, bonds were on pace for their worst year ever. Interest rates had risen. 10-year was above 170, and all of these inflationary trends were just starting to percolate. Right, we're hearing about it, we're starting to see it, and now we've seen follow through. We've seen the actual data. I think it's exceeded most people's expectations in terms of how high it's been, and that it's lasting here now for a few months, and at least, and maybe more. And so the interesting thing in the last 2 months is we've seen a complete reversal in bond yields. If we're looking at treasuries, where they're back 10 years back down to 1.2%, given this inflation backdrop. So that's certainly something that shocked me. I wasn't expecting that. And there could be a number of reasons. Perhaps they're anticipating this is not going to stick around, the inflationary environment. Perhaps they're anticipating some economic weakness next year. Perhaps it's just a global supply-demand dynamic where people are buying treasuries because that is still in the developed world the highest yield. So you still have negative yields in Europe and in Japan, and perhaps it's just a relative play. So we don't know the answer to that, but that's certainly something that's shocking that bond investors would be willing to accept that low level of return given where inflation is. So it's very difficult to make the case that buying a 10-year bond at 1.2% that you're going to be able to keep up with inflation over the next 10 years, unless you think not only is it going to come back down, but it's going to be less than it's been. So less than it's been historically.
All right, so we've got more charts on yields and things like that we'll get into. But before we get off of the inflation, I like to start looking at home prices. So, walk us through it.
So I love the chart because it kind of serves as a reminder. I put up on my wall, just a reminder that throw out everything you ever learned in terms of economics when it comes to this pandemic, right? So I started out in the credit markets in 2005, 2006. And the first thing you learn looking at home prices, looking at housing historically, is that housing prices and trends generally track inflation, and they also generally track unemployment levels. So if people have jobs, that's good for housing. If there's more demand, so on and so forth. Right. So then we're supposed to have the second Great Depression last year. Unemployment does go up to 14% briefly. And a funny thing happened. Housing prices didn't go anywhere initially, and then they started to go up like crazy. So it turns out that you have to dig deeper in the numbers. So the fact that we gave people who were unemployed more money when they were working, well, that changes the whole equation with unemployment. And then the stimulus payments, if you're going to give, I think the average family of 4 or 5, got 15,000 total. That's a decent down payment in a lot of areas of this country. So throw everything out in terms of historical predictors of housing markets. Last May, basically, you could have said this is different, and then from there it's just continued. Right, every single month we're seeing new highs. So this is a chart of existing homes, and over the last year, it's up 24%, which is the largest increase ever. In the last 10 years, they've more than doubled. So you have to ask the question now, and are we approaching a second housing bubble in the U.S.? And we haven't had to ask that question. Would have been ridiculous to ask that question 10 years ago, right? And now here we are again. So this is an interesting phenomenon. Again, it's a supply-demand balance. You have very few homes for sale, and you have people entering the market with money that they didn't have, and now they have it, and they want to spend it, and normally that would be a reasonable thing to do. And so this is something I think a lot of people will be watching closely if this comes in over the next few months.
Yeah, me included. And if that chart made me happy to be a homeowner, this one made me a little sad since I own my home in Chicago. But, walk us through the actual regional breakdown here and what that kind of means as far as your sentiment in general.
Yeah, this is a chart I put together every month. I have it saved in my YCharts in the watch list. So it's a 20 city Case-Shiller index. So it's looking at 20 major metropolitan areas around the U.S. And I'm just pulling in percentage changes over different time periods into this table. So here we have it sorted by 1 year rate of change. And yeah, even in Chicago, where you are, every single city on this index is up over 10% over the past year. So it's really been a rising tide that's lifted all boats. And areas like Phoenix, which people remember from the last housing boom, was one of the leading cities for sure, have just seen tremendous growth. Right? So you've seen some people, there's been movement too during the pandemic, and certainly the South and Southwest has seen an increase in demand for people that were willing to move. And so that's driving things as well. I don't think it's strange to see San Diego and Dallas and all these other southern cities starting to take more share, and seeing them leave the Northeast or the Midwest for these cities. But the rate of increase is extremely high. It's the highest we've ever seen. Even during 05, 06, we never saw nationwide home prices rise this much in a single year. So again, just a complete shocker for most people heading into the pandemic that you would see. this much demand. And so the only cure for this is going to be supply coming into the market and just people starting to back up and say, this is getting too high. It's becoming unaffordable at these levels. So we'll look for signs of that. We're not seeing it yet. I expect to see it in the next few months because this rate of increase, we talk about sustainability, not really sustainable unless mortgage rates were to continue to go down. And that's been the one factor just really helping out. We talked about bond yields coming back down, but mortgage rates as well have come back down in the past month or two. We're seeing a 15-year mortgage rate hit another all-time low here last week. So getting closer to 2% on a 15-year mortgage. So that's driving things as well.
Yeah. Crazy, right? And you look at this, you look at these last three charts, you look at, some of the many other charts that you put together on your blog, and you mentioned things like auto sales. This inflationary trend seems apparently obvious, right? It's hard to look at it and not notice it. However, there may be people out there that make you, try to make a case otherwise, right?
Yeah, and that would be the Fed, and they're meeting again tomorrow. So I'll put out my post that I put out the day before every Fed meeting, which is tomorrow's news today, because we know exactly what the Fed is going to say and what the Fed's going to do tomorrow. They're not going to raise rates. They're going to tell you that inflation is transitory, which of course is true. Everything is transitory. Nothing is forever, right? But they'll also say that it's not problematic, and therefore they can leave rates at zero until 2023. And that's the right thing to do and necessary. And there's going to be very little pushback when they do it. People will point to all of the examples that we've talked about, but the Fed has kind of maintained the position that the risks of higher inflation are not substantial, and they view that that's going to come back down, and it's better to have this ultra easy emergency policy and kind of see what happens and hope for the best than to start tightening at this point in the cycle. And are they right? Are they wrong? There's a lot of commentary. I think we can disagree on that point. The difficult thing is to say that just because these higher rates of inflation are transitory, perhaps we're not going to continue to see 5% inflation, a year from now. But that doesn't mean prices will come right back down, nominal prices, right? So it's going to be, a lot of this stuff is going to be stickier, I think, than the Fed is anticipating. And
sure.
So that'll be a trickier animal. And certainly to suggest that, and this is what they'll also say tomorrow, to suggest that Fed policy has nothing to do with this higher inflation, I think is a little bit of a stretch. I think a lot of areas it has something to do with it.
Sorry, Charlie. So looking at this, right, you've got the spread here showing the actual effective Fed funds rate less the CPI, right, showing that real rate. So when real rates are this low, who does that benefit? Who does it hurt? How do you think about that going forward as far as positioning?
Yeah, it certainly has been an impetus for investors to say take more risk, and they've been largely rewarded if we're looking at U.S. equities, particularly large caps and the like. So it's certainly benefited equity investors. Not very good, obviously, for people with savings accounts or money in checking accounts, right? They're just losing real purchasing power, right? So that's anyone on a fixed income, not very good, right, for these people. And I guess in terms of the real beneficiaries over the last year, it's even with a huge correction, has been anybody of the belief that crypto has a case because of what the Fed is doing. Certainly, it's benefited the crypto investors, even with the pullback we've seen over the past few months.
Yeah, I've heard a little bit of the school of thought that this effect also does some, I guess, dispersion of wealth, right? If you have your net savers typically being people that are more wealthy and your net spenders being people that have less wealth, and if this benefits the net spenders over the net savers. Do you agree with that sentiment, or do you think that's maybe diluted down too much to hold up?
Oh no, absolutely. This is if you wanted to help widen the wealth gap, this would be the the policy you pursue, right? Because the wealthiest people have the most assets as a percentage of their wealth, and people on the lower end who are just starting out, they don't have assets yet, right? So anybody who has a house is happy about this. If you're coming into the market to buy a house, obviously not very happy about this. And then the extreme goes up and up, right? So like Jeff Bezos is terrific, right? He's going to double his net worth over the past year, but somebody who doesn't have stocks at all or has very little, they're losing purchasing power, right? So they have to hope that their wages are keeping up with the rate of inflation. Otherwise, they're relative gains, which is interesting because you'll also, from time to time, Powell gets that question, and he always portrays this as something that's helping the quote unquote common man, the worker, and it's hard to. That seems to be a little bit disconnected. I mean, he's making the case that this policy is going to help employment, and therefore it will help them. But I think he's ignoring obviously the other aspects, like the negative impact of higher prices,
which maybe leads to this balance sheet picture, right? So I guess just kind of more a different way to look at what's happening, but talk us through.
Yeah, more of the same, right? This will be what the Fed will cut first, right? So they'll slow this down, which they haven't done yet. They're doing about 120 billion a month in new purchases on their balance sheet. We're up to 8 trillion now. Pre-COVID, it was 4 trillion. And so, tomorrow they'll say we need to keep doing it, but at some point we'll see. They'll say we're going to slow this down and eventually stop it. But the amazing thing is that they're still doing it, particularly in the housing market, which is unbelievable to me. That with housing prices where they are, with housing activity where it is, why do you need to keep buying mortgages when mortgage rates are at all-time lows? Why do you need to keep you're essentially throwing fuel on a fire that's building? And if there is another home bubble, you can point to things like this as questioning, like, why was that really necessary? And obviously, they feel that it is, but I think that's kind of questionable at this point. Why is it necessary?
All right, so we've covered the reopening, the effects of inflation, quite a bit. Moving on to kind of our next topic here, which is just the ups and downs, right? The rolling manias. So there's certainly been some excitement in the market in the first half of the year. Talk us through some of these.
Oh gosh, yeah. There's been a ton of excitement. So if you like action and during the pandemic, and I guess it started out as a joke, but I guess it became true. People were working from home or they're home and they have more time, and some of them read books, some of them exercised more, and some of them played the stock market like a video game. And and we really saw the culmination of that this year with the 2 additional rounds of stimulus, where you just saw investors keep going higher and higher on the risk spectrum. So it started out with just stocks, and then tech stocks, and SPACs, and then IPOs, and then it's going to reach the extreme with I think Dogecoin has to be some type of extreme where it's a coin, and we don't have to get into it. I think people probably heard it from friends at some point or by now, Elon Musk. And it started out really as a joke. It was created as a joke, but it wasn't a joke in May when this thing is up 12,000% and everybody's talking about it. And Elon Musk is on Saturday Night Live and joking about it. And this is just one example, right? Many other coins like it, but I think this is the funniest one where
and this chart doesn't show the downside of that though, right? What's happening?
Yeah, it doesn't show the downside. It's down around 80% since then, so that's pretty good. And it could go down 99% or it could come back. Nobody knows. But I think the point of these rolling manias is we saw so many of these different aspects, and crypto and really the meme stocks are the 2 most prominent examples. So of course, GameStop, you can't talk about the first half of the year without talking about what happened with GameStop and AMC and the rest of them. Really, in late January, started out again on the Reddit message boards, and GameStop was the most highly shorted stock of any stock in the listed stock in the U.S. entering the year, and rightfully so. They identified that, and it was really a short squeeze for the ages. And like all manias, it gets taken so far, and we've just seen a number of crashes and rallies in GameStop over the past few months, and I think we're going to continue to see this in different stocks. And every week it seems like there's a different stock that this crowd is targeting, and you see just these miniature boom bust cycles wherever there's a frenzy, herding activity going into these names, and then typically it comes right back out. GameStop and AMC has really been the exception to that. But a lot of these other names really changing dynamics within the market. And this wasn't possible, I guess, 10, 20 years ago to have so many people focused on one thing. It was just an incredible thing. And if we look at just retail trading activity when GameStop peaked, it was just more volume, dollar volume was traded in GameStop on the day it peaked there in late January than was traded in Apple, which is a $2 trillion company. So this really captivated people. And if you talk to people who are not usually involved with markets, Caleb, they probably brought this up because
yeah, absolutely.
And the amazing thing is who benefited most from this and is the brokers like Robinhood. I mean, they were adding millions of accounts during this because of that activity. That was the go-to place. So that's kind of an ironic thing that's come out of this is that they really did well because of the captivity and the attention that it got.
Yeah, I mean, you said it, right? I heard more questions from people that I hadn't heard from in a long time, text me about GameStop and AMC, and, it's certainly interesting. The thing you look back at, though, right, it's still up big over where it started, yes. Right? There's a lot of volatility in there, and a lot of people probably took a bath. But how do you answer questions when investors come to you and say, hey, wouldn't we still be up, 1,000% had we acted?
Yeah, you would have. The problem is identifying that and what is the risk reward of being concentrated in a position like that. Like, someone who bought it there in January chasing it, and then all of a sudden you're down 90% on that position. Are you going to stick with it? Are you going to buy more, just based on a mean? There has to be something more, right? Maybe for a trader, these high frequency firms love this. That's the other ironic thing is the high frequency hedge funds made a killing off of this activity, right? This was supposed to be something billed as sticking it to the man or sticking it to the institutional players. And I think for the most part, they benefited from it, either because GameStop was considered a value stock and they had it in their portfolio, or just trading that volatility in general benefits the hedge funds, right? So there were a few hedge funds that lost big, but more of them actually have done well on this. So I think the lesson for investors as best you can, if you're going to do something in this stuff, keep it very, very small, and better still is just to kind of ignore it because you're unlikely to time it on the right way.
So it wasn't just with these highly concentrated positions where we saw volatility in the first half of the year, right? I mean, even some bigger, well-known ETFs, saw some volatility. So talk us through some of the trends on this chart.
Yeah. So advisors on the call and even individual investors would be familiar with these two areas of the market because they were really the hottest going into late last year and first 2 months of this year, right? So you have SPACs on the one hand, you had $1 billion in SPAC issuance a day, I think, for the first few months of this year. So passing the record total from last year in just a few months. $1 billion a day is an incredible number in terms of new issuance. And at the same time, the SPAC is going to public and it's gapping up 5-10% without any, you don't know what it's going to buy. You don't know anything about it. And it's just going right. So that kind of hit a peak in February. And at the same time, high growth names that had really killed it post pandemic. ARK is just one of many ETFs that we could put on here with a similar trend, but it's the most glaring because they raised just a ton of assets on huge performance last year. And the point here is that there's no reward without risk. So you're going to have huge drawdowns if you're going to have huge gains. There's no other way. So these areas of the market, while the S&P barely had it had one little 5% pullback there in February, March, it came right back to new highs. But these areas are still well below their highs in February, and they saw 30 to 40% declines. And SPAC issuance is really almost dried up now. It's very little, and you're seeing some of these high growth names really come back. Come back to reality, so to speak. So this is just a cautionary tale. There's always risk, and just be aware of what you're investing in. If something's doubled over a short period of time, that means it could go down, 40, 50% very quickly as well.
Sure. And despite all the volatility, all the action, all the excitement, it seems like that volatility really has been kind of washed away, right? At least from a statistical measure.
Yeah, well, at least through the first half, unbelievable. So we saw a record high VIX last year during the pandemic, kind of peaked right around where the market bottomed, and came back down, but really started grinding lower only this year, and now we're back to pre-pandemic levels on the VIX, at least through the first half of the year, which is kind of very interesting given all of the volatility we've seen in meme stocks and crypto and these other high growth areas. The overall VIX is just measuring the overall S&P index has been relatively calm. So I think just be aware, obviously, that that's not going to last. There's going to be more corrections and volatility, but just tremendous in 1 year for go to be maximum panic and maximum volatility to kind of, okay, that was it. Now we're back to normal.
Well, that's been one of the interesting things this year, right? And last year too, there've been all of these really kind of bizarre instances, whether it be the meme stocks you're talking about or hyper growth in certain crypto assets and things like that. But they've really been concentrated. And if you kind of peel those away and just look at the market in whole, it's been relatively, I don't want to say calm, but it kind of just trending in the same general direction, right?
Yeah, we hit 34 all-time highs in S&P in the first half of the year. That's
1 in 5 trading days then?
Yeah, almost the most we've seen in the first half. So yeah, the broad indices have really shrugged that off. The case there has been, we've seen a V-shaped recovery in earnings. Earnings hit a new high in Q1, and that really got investors excited, right? That higher retail sales number flows right through into higher earnings, and companies have been able to keep costs down, so they're just making it more profitable than ever, and that that has led to a good backdrop, right? And then, but what I would say is there's going to be something, we don't know what it's yet. It's probably something to do with China and what's going on there, and recent weeks. But there'll be some catalyst for more volatility in the back half of the year. The odds suggest anyway that you're likely to see more volatility.
Yeah. Well, let's come back to China. And talk. I know we've got a couple questions on that, but before we do, the recent moves haven't just been in the stock market, right? I think this is something we actually talked about at the beginning of the year too, looking at the yield spreads. So that's changed.
Yes. So this is a chart of high yield bonds, junk bonds, their yields in the dark blue, and the spreads, which is just the difference between high yield bond yield and the similar duration treasury in the light blue. And we saw high yield bonds, and at the end of June, go below 4% yield, which is incredible. Remember, inflation's running at 5%, and you're less than 4% on high yield bond, which is unbelievable given where we were, in March 2020, and people thinking that there was going to be massive defaults and so on with everything that was going on. And if we look at credit spreads back to 2007 levels, around 3% above Treasury. So this is a sign of just huge risk appetite and reach for yield. You could call it many different things, but people are very, very optimistic on the future. They're not giving themselves very much of a cushion if you're buying a high yield bond today in terms of if things are worse than expectations. But that's been good for investors up to this point, right? Of course.
Yeah, I mean, you mentioned those two things, right? Reaching for yield, risk appetite, those things come together. The S&P 500 yields close to 1.5% even, right? So even even the spread between that and something like a high yield bond here, not huge.
Yeah. Yeah. Just a historic outlier. And, Fed policy is part of it, but I think a bigger part is just sentiment and optimism.
Yeah. Another trend that we talked about, when we got together at the beginning of the year, Charlie, was the sector reversal, right? We saw a lot of sectors that had really been kind of hammered in the first half of 2020 come back and make big gains near the end of 2020, early 21. You did some catch-up research here on this and then continue to follow this trend and talk us through what this is showing now.
It's a good reminder. Mean reversion in markets still exists. If you were pessimistic that what happened in the energy markets last year and what happened in financials with interest rates and commercial real estate, if you're pessimistic last year, thinking that was going to stay around a while, it hasn't, right? So we've seen the worst sectors from last year, at least through the first half, become the best sectors this year. Crude oil is at the highest level since 2018. We're seeing gas prices highest since 2014. Financials have benefited at least from the steepening of the yield curve, and real estate just chugging along. It kind of boggles the mind. We still haven't seen a recovery in terms of people going back to the office, but we've seen a recovery in these stocks and then some. So I think that was unexpected. And on the other side, we've seen tech, which was the best performer in the last year by a wide margin, and consumer discretionary down in the bottom half of sectors, at least for the first half. So certainly an interesting reversal from what we saw last year, and kind of ties in with recovery in value stocks, the other themes within the market that we saw reversals from last year.
Yeah, and speaking of things that kind of changed over the year, as we continue on this trend of the optimist winning out, right? So we talked about this a little bit with the meme stocks, but just some of the biggest gainers in the Russell 3000. Just absolutely massive numbers here. But how do you think about this?
I just think it's incredible. There's nothing. It's almost nothing more you could say. You would have expected them to come in more than they did. Just looking at fundamentals, looking at comps in the sector, and they're not. And so it's the power of sentiment and power of behavior. Their staying power there. Ultimately, they're going to trade back to the fundamentals. But that could happen next month, or it could happen next year, or it could happen much longer. The interesting thing is most of those shorts, at least in GameStop, they're gone. If you look at the short interest, it's back to lower than it was 10 years ago in GameStop. So that thesis isn't there anymore. And now it's still the power of if you put this thing in front of millions of people and say something positive, some of them, I guess, will buy it. And that alone is enough to sustain it. But again, longer term, eventually they have to make a fundamental turnaround, or people won't hold on. But in the meantime, they've used this. AMC's done this unbelievably. They've raised multiple rounds of new capital, right? So it's not just a fun thing for investors. Like, there's actually corporate behavior. They're using it to, and the question, will they do something with it that's valuable? But they're not going away anytime soon now, just raising that additional capital. So that's something that's changed as well. Companies can get this boost from this meme stock and then issue stock, and so it can be kind of self-fulfilling if they do something good with it, I suppose.
All right, so let's I guess wrap it up with our last chart and maybe take it back high level, right? So we've looked at a lot of kind of individual trends, but I like your bonus chart here because it kind of reminds me of the impact of diversification and a kind of well-built portfolio. But just talk us through the overall asset class trends and what you've seen year to date.
Yeah, so year to date through the first half, it's been a pretty good first half if you're a global diversified investor, and particularly in U.S. stocks. And the interesting thing here is commodities, which have been, if you look at the last 10 years, commodities were the worst performing asset class heading into this year. over the
I know
prior
there were
10
a lot of
years.
advisors struggling to defend their commodities positions for the last decade or so. So
Oh, for sure. Anyone who had it still coming into 2021 is finally getting paid for it. Here with that outperformance, I think seeing REITs as in the number 2 spot is interesting as well. Again, I don't think many people anticipated that after last year. And of course, Bitcoin's up there, and U.S. stocks have really outperformed international. And then on the bottom side, again, diversification usually means that something's going to be, if not underperforming, could be down. And we're seeing just bonds in general through the first half, and long duration bonds really underperforming, in gold as well. So all in all, good first half of the year. Anyone who was pessimistic after last year, again, through the first half of the year, it's been a difficult road if you're a pessimist. If you're an optimist, it's been a pretty good first half of the year.
Yeah, certainly. And, I guess getting into one of the questions that we kind of pushed off a little bit, and maybe it's captured a little bit in some of these asset classes, but what's your, I guess, recent take on what's happened in the Chinese stock market and exposure there?
Yeah, it started out as just small signs of weakness a few months ago. You're starting to just see this divergence where U.S. tech stocks keep hitting new highs, and Alibaba and Tencent, bigger Chinese names, are pulling back. And just every week over the past few months, we've seen a new data point coming out of China, suggesting that they're either taking increased scrutiny, or they're going to just take more control over different sectors of the economy. They're not allowing certain transactions. With the Diddy IPO, comes public. They didn't like the way they did that, and they're stopping users from downloading the app. So just there was a case for a long time that China had really embraced global markets and capitalism, and that the restrictions on freedoms elsewhere there, you could overlook that. And I think investors are starting to question that thesis, at least as it pertains to the stock. So it as always, it could be an overreaction, right, in terms of, like, let's say, broad emerging markets exposure in China. But if there's going to be a fundamental change where they're changing literally in the education sector, we've seen stocks in the past week or two go down 50-60% in a day. And there's, so far, it's really just a few comments made by a minister here and there, talking about they don't like this group, this sector seeking profits. They don't like the pressure that's being put on families, having to pay for tutoring services, and just little comments like that get people worried, like they could step in at any point in time and say this is now a nonprofit business. So there's always been skepticism around China. I think it's just now we're starting to hit the point where people are saying what's real, what's not, and how much can they change things. So again, short term, you could always see sentiment extremes, and certainly people seem to be panic selling, like, broadly in some of these areas. But that's a legitimate concern, right? It's just an interesting philosophical question, right? Does the lack of freedom ultimately impede growth, like, regardless of whether they come in and say Alibaba can't do this or Tencent can't do that, or right, in terms of an acquisition, or in terms of that, is it going to impede growth, this lack of freedom in many areas, right? So I think that's an interesting question, and I think there'll be spillover, though. If this decline is going to continue, it's not just going to be limited to emerging markets. It's going to impact U.S. markets as well. It always, when it gets to a certain extent, it always has in the past, and it likely will again. So yeah. Long answer to a very deep question that people have to think about in terms of their exposure to, and or is it just an investment, or do you have to think about, are there other risks here to think about? And is it something where fundamentally you're going to have a lower growth rate because of the structure of the economy, right? That's changing. And can you believe the numbers, right? As well, there's always been questions out of China looking at their GDP numbers, looking at anything. They seem bizarre at times. They don't seem to match reality. And then if that filters over to companies as well, which we've seen, from time to time in the past few years, there's going to be that increased skepticism. So what's fascinating, though, Caleb, is that it was only a few months ago, we go back to February, where these were the favorites. Like Chinese internet stocks were leading the market. So, last year, it was a boom year for all of these names. So it shows you that sentiment can change on a dime. And if you looked at valuation multiples last year, I'm writing a piece on it now, I'll probably put it up later today on the blog. All of these stocks are trading at a premium to U.S. stocks, which is fascinating. So now they're, part of it is just a revaluation of that expectation. So the expectation was, we want to be in China. China's growing so fast. They're not allowing Facebook in China. They're not allowing Google in China. So we have all these natural monopolies. We're not allowing Amazon. So of course you want to own these companies that are growing phenomenally fast. Therefore, they deserve a premium over U.S. valuations. And now we're seeing that flip, very quickly in a short period of time. Which is the way markets work. Right? It's like suddenly and then all at once.
Sure. And I guess, one of the trends that I'm really picking up on just from our conversation today, right? And I guess obvious when you take a step back and look at it, but just this, regardless of what asset type we've been talking about or what area of the economy, just this, risk on trade where we see just a massive run up in whatever it might be, which is seemingly maybe not as understood as it should be, when the investment is happening. And then the repercussion of that after the fact for one reason or another, whether it was, hype or, some overlooked geopolitical factors or something like that, where we're seeing the effect, soon after and seeing these very aggressive bubbles and kind of bursts in small areas, micro bubbles. Is there anything that you see right now as kind of in that position right now as being really highly inflated and probably, soon to come back to reality?
Yeah. I mean, most of it has come down. I said a few months ago, it would have been crypto. Before that, it would have been the memes, and we've had waves of these meme stock waves. But that doesn't seem to be at a peak. SPACs again peaked early in the year, and they're still well off. We've talked about China.
You put real estate in that category yet?
Oh, real estate as equity exposure or outside that?
I guess it's a way. We see REITs here have performed extremely well. But
yeah. So part of that has been interest rates pushing down, right? Mortgage rates going down. Yeah, I'd be concerned about real estate. Look, just comparing U.S. home prices to the gains we've seen in incomes is starting for me to get to a point where, but in the private market, it's very, very different, right? Things happen much slower. People are very reluctant to they'd rather stay in a home for 10, 15 years and get back to even psychologically than sell it at a loss. So it can take longer for these things to play out than you see obviously in the public markets. And certainly we haven't reached, if we're just looking at home price to income ratio, we haven't reached that housing bubble levels yet, but we're getting closer in some areas. I'd just say watch it, be careful, respect that there are fundamental laws in terms of how much you can afford. But in the real estate market, what's also interesting, Caleb, is we're not seeing that huge credit expansion yet. So we're not seeing, like we saw during the last housing bubble, yet we're not seeing people buying 2, 3 homes. We're not seeing these very low down payments, right? So, and consumer, in terms of like servicing that debt, it's never been better because their mortgage rates are so low, right? And prices are up. So as a percentage of that asset, so maybe we have to see that first. Maybe it has to get more extreme.
Maybe the banks aren't willing to take the risk, right?
Right. Like every bubble historically becomes a credit bubble because the fear of missing out reaches a reaches a breaking point, people can't take it anymore, and the people who missed out then want to borrow money to leverage that return. So usually you see that before the end, not always. So who knows? Maybe there's more to go, but that would be one area that's certainly still at highs and hasn't pulled back yet.
All right. Well, Charlie, we're at the top of the hour. I know that was kind of our target here to cap everything. There are a lot of questions that came through that we didn't get a chance to cover. So, maybe we can answer those offline or get a chance to follow up with people there. But
Great.
I just want to just give you another kind of sincere thank you for joining us today. And I think we're going to be doing this on a little bit more of a regular cadence going forward. Is that right?
Yeah. Once a month. May not be this long. We'll try to shorten it up a little. Once a month, we'll pick out the most interesting charts going on in markets, and there's always plenty to choose from. And it's always fun. Thanks everyone for joining us today, and reach out with questions and feel free to again use the charts. And I know you guys are going to put together a lot of templates so people can use them if they're on YCharts. They can find them easily or recreate them and do whatever they want with them, which is great. And so it's all about education in the end. And that's why we love doing this.
Well, good. Well, we appreciate it, Charlie. If anybody does want to reach out too, feel free to reach out to YCharts or Charlie on Twitter and ask some questions there. But I look forward to, doing this again next month. Like you said, probably with a little bit less content, but, until then, thanks and take care, and we'll talk to you soon.
Yeah. Have a good one, everyone. Have a great rest of your summer.